The journey of Bangladesh toward becoming a developed economy by 2041 is fundamentally linked to international trade, a system that expanded almost 573 times between 1973 and 2017. But this vital system is vulnerable. Global bodies recognize that the international trade mechanism is heavily abused for money laundering and terrorist financing, posing a significant and growing threat, especially to developing nations. Since international trade transactions primarily flow through the banking system, the Bangladesh Financial Intelligence Unit, BFIU, issued comprehensive guidelines to help banks establish appropriate measures to combat this crime. This framework employs a specific risk-based approach, designed with the unique context of TBML in Bangladesh in mind, ensuring controls are adaptable and effective against changing crime typologies. Combating TBML must start at the foundation, the infrastructure level. Without adequate internal infrastructure, mitigation measures cannot be implemented effectively. Banks must develop specialized capabilities for price verification, transaction monitoring, and screening, aligning these resources with their exposure to international trade risks. This crucial infrastructure includes implementing a standard sanction screening process and maintaining clear standards for manual screening. Banks are also guided to develop their own transaction databases based on historical operations, subscribe to publicly available online commodity pricing websites, and establish a reliable vessel tracking system to monitor shipment details and history. The next critical defense line is the customer level, which is essential because high-risk clients engaging in dubious trade are often the source of fraud. Banks must begin with a general ML/TF risk assessment when initiating the customer relationship. This is followed by a trade-specific risk assessment, often utilizing a scoring model that incorporates factors like customer demographics, the geographic locations of trade, the products, services involved, and their historical transaction trends, TTP. If a customer is determined to be low or medium risk, standard customer due diligence, CDD, applies. However, if classified as high risk, the case must be escalated to Level 3 officials for further scrutiny. Only after Level 3 approval and the completion of enhanced due diligence, EDD, can the customer proceed with trade transactions. The transaction level is the most vital stage, as this is where TBML physically occurs. The guidelines mandate a 3-level review system for processing and escalating alerts before execution or rejection. Every trade request must undergo initial TBML alert analysis and sanction screening at Level 1. Alerts unresolved at lower tiers are escalated through Level 2 and finally to Level 3 officials, who determine if a suspicious transaction report, STR, or suspicious activity report, SAR, is warranted. Concurrently, banks must conduct enterprise-wide TBML risk assessment and mitigation. This holistic process requires senior management review of policies and strategies, integrating internal inputs, including aggregated data from Level 3 escalations, and incorporating new trends and typologies to mitigate risk institution-wide. These BFIU guidelines provide a necessary risk-based approach that explicitly guides how TBML risk emerges and dictates how due diligence should be applied. The structured framework spans 4 critical defense domains: infrastructure, customer, transaction, and the enterprise. By establishing documented, periodically reviewed policies, banks can effectively assess and mitigate the specific risks arising from their trade-related activities. The BFIU expects every bank to implement these practices, thereby improving their counter-TBML/TF measures relative to their unique exposure. This layered defense mechanism is essential to protecting the nation's financial system and ensuring Bangladesh remains at the forefront of global anti-money laundering efforts.